Right, good afternoon, ladies and gentlemen. It's just gone 5 p.m., so I'll make a start. My name is Andrew Schaefer from Trafalgar. Many thanks for joining us and for following our training and information sharing webinars. Just like to start with introducing our panelists and guests tonight. Our special invited guest is Alistair Scaltz, who has many years of experience with financial management for community schemes, both within Trafalgar and outside Trafalgar. And for several years now, Alistair's been, part of Octagon PKF's audit team, focusing on the annual audits for community schemes. So, Alistair, welcome. Thanks very much for joining us tonight. We appreciate it.
Thanks.
Also joining me are my colleagues, Karine Kutsia, that's familiar to many of you, our panelist monthly on our webinars, and Shahim Carr, who's a director with Trafalgar and has extensive experience with financial management and reporting for community schemes. Just a few words of introduction. We will endeavour to complete promptly by 6 p.m. as usual. Please do drop your email into the Q&A if you'd like the slides as well as the link, the recording link for this webinar. We'll gladly circulate that to you after it's been uploaded. We will try and make this as interactive as possible. So, please do raise any questions you've got. We will endeavour to answer online. I will try and sort of group any questions and pose it to our panelists as and when they arrive. And our contact details will be given at the end of the webinar. You're welcome to contact us afterwards if there's any further questions or anything that we didn't get to during the webinar. There will be a short survey as usual that pops up at the end. We would appreciate you taking 15 to 30 seconds to complete it. It's an opportunity to suggest other topics you suggest we cover. That's very helpful. And also just feedback to help us tailor and improve the delivery of these training and knowledge sharing webinars. So we'd appreciate any feedback that can be given through to us. Right, onto the topic this evening. It really focuses on financial governance, which would include financial management, financial reporting, as well as audit compliance and tax compliance as well within the collective of financial management. It's an absolutely crucial topic because as with any business, it's essential that a community scheme has effective financial reporting, that those financial reports are reviewed on a monthly basis. Highly recommended that both the chairman as well as a financial director or trustee take the time to review those each and every month. We'll be covering some of the key factors and items that should be evaluated on a monthly basis. And we'll get to talking about what compliance elements are important to take care of and who and when and how those should be done. It's important just to think about who are the users of these financial reports. Certainly every AGM is required to have the presentation of signed, audited financial statements for review. So it's very often the key dependency to being able to convene the required annual general meeting for a community scheme. The managing agent does check those for accuracy and alignment to the management accounts, but it is reliant on the relevant directors or trustees, two of those, to sign to be able to include in the agenda packs and present for review and consideration at an AGM. Secondly, those signed financials are required to be submitted with SARS with the annual tax return following year end. It's another important user of those reports. And also buyers and sellers, buying and selling properties in your community schemes should be looking at the audited financials as a record of the financial status and health of your scheme. And clearly that would impact the value of properties, the perception of value in your properties, and therefore the appreciation of, one of the biggest investments of owners in your community scheme. And those are just a few of the examples of why financial management is absolutely essential. Not to mention the fact that effective budgeting obviously sets the levies paid to be able to cover expenses, and paying expenses maintains service delivery in your schemes. And all schemes are reliant on paying municipal services, security, and many other costs to keep them operating, to keep them functional, to make sure that the lifestyle of residents meets their expectations and that it's fit for purpose. And getting it wrong, neglecting it, allowing gaps to manifest and grow is obviously clearly a risk for continued service delivery in your complexes. It's a risk for buying and selling property. It certainly is required by SARS and banks, etc., in the way I've explained. And, it's an essential focus area for a minimum, the chairman and finance director or trustee in your schemes. So with that introduction in mind, I'm going to hand over to my colleague, Karine Coetzee, who's just going to recap on a few of the relevant legislative provisions, just to be aware of, because these are some of the parameters which inform the way that financial management needs to be managed, needs to be undertaken, and needs to be compliant. So Karine, if you could carry on. Thank you.
Thanks. Thank you, Andrew. So just as an introduction, I wanted to highlight a couple of things. First would be know your financial year end. So with the previous Sectional Titles Act, the default financial year end was February. With the new STSM Act, the Sectional Title Schemes Management Act, the default changed to September. But that doesn't mean that you as a scheme cannot change your financial year end to whichever month you would like. And Alistair and Shahim are going to talk about February year ends and the effect of February year ends in a while. But just a reminder that in terms of Prescribed Management Rule 21.1, you only need an ordinary resolution by the body corporate, in other words, a majority vote by the body corporate, to be able to change your financial year end to a month that is more suitable. Alistair and Shahim will talk about the administrative fund, the reserve fund. Those are two required funds that the body corporate must have. So those are two budgets that needs to be approved and two levies that needs to be raised by each body corporate. You need a trustee resolution to raise levies. Levies are only effective and payable if that trustee resolution has been passed and signed. We call it a levy resolution that we get our trustees to sign. And then also the Act requires that circular needs to be sent within 14 days after the AGM to the owners to tell them about any levy increase that is what was approved at the AGM. It is also important that you make sure that there are contributions, if applicable, on exclusive use areas. That is sometimes a loss of income that a body corporate is not seeing and not actually charging the owners. And as Andrew said, and audits to be done and presented at the AGM. And then it's also important that proper debt collection procedures be in place. We have an interest resolution that we get our trustees to sign in terms of what interest percentage can be raised on arrear levies, and also a handover resolution for arrear levies to be handed to attorneys, or we can take them to CSOS, whatever the case may be. But yeah, this webinar not really about debt collection. We had one previously on that. If you want to go watch the recording, it's on our website. But yeah, that's basically just highlighting a couple of things. What we did for your convenience is to put together a table of certain things in terms of financial compliance, what needs to be done, how often does it need to be done, by when, what document are we talking about in order to prove that this was done, and what is the requirement. So you will see that most of them are requirement by law. We've spread them over a couple of pages, so if you request the slides, you will be able to have the whole table. But we just basically spread them to be bigger so that you can better see. But these are basically financial compliance items that each body corporate need to take into consideration and to have a look at, and to make sure that your scheme complies. And that's the last one. And then, yeah, over to Shahim and Alistair.
All right, excellent. Thank you very much, Karine. I'm coming to you shortly, Shahim, to lead a Q&A with Alistair. Just to emphasize again, the importance of housekeeping and having those documents in place, which Karine mentioned, which you can refer to on the slides if you do request those. But, as we covered in the debt collection webinar, not having those documents in place compromises and undermines the ability to enforce debt collection, enforce legal collections. We have seen cases where debt collection has failed because those documents haven't been in place to underpin the monthly levy collections. And as much as it might seem common sense that levies are due monthly in advance, unless it's written in a resolution signed by the trustees on a written document which can be presented in court, it's not admissible, it is not assumed to be in place, and it can compromise levy collections. So the very basis of collecting levies to cover expenses of a community scheme is absolutely reliant on that housekeeping being in place and being updated on an annual basis. And the frequency of that would be following the AGM once the budget has been approved. And that's really the bottom line. It might seem slightly confusing and overwhelming, but certainly managing agents are in place to assist. Our contact details are available to refer to. It's an annual cycle, so it does become repetitive and familiar year after year. And, most certainly it's the cornerstone of financial management that an approved budget at the AGM really sets the levies to cover the expenses. When we are asked what does the levy cover, well, the approved budget shows what expenses the levies are set to cover, and certainly the levies must be set to cover the expenses with a small surplus. And in the case of sectional title, that refers to admin costs and the admin budget, and separate to that is the reserve fund, as Karine said. But please, get the housekeeping right, make it a annual focus. Certainly the chairman and financial trustee should be aware to double check the managing agents as well. There should be a document management system which archives those, very clearly and very securely. And so that does perform, a function of securing levy collections, debt collection, and unfortunately legal levy collections as and when the need would arise. So let's get it right. And it's very disappointing where court cases fail because simple documentation of that nature is not correctly in place. All right, thank you very much, Shahim. Over to you for the next section.
Thanks, Andrew. Can you just allow me to switch my camera on? It says the host has blocked it.
All right, there we go. Should be set.
Okay. Good evening, everybody, and welcome to our webinar. This evening, we're going to have a different format. Although financial compliance is such a broad topic, we're just going to focus on a few aspects. Just as an introduction, as you all know, that is quite a growing industry, the sectional title and homeowners association industry. Obviously, most people would love to live in a gated community that looks beautiful, that's got a good set of financials, etc. So for us as managing agents, we do recommend best practices when it comes to compliance, etc. And overall, in the topics that we're going to cover, these might be good tips to enhance what you're doing currently. And hopefully, if you don't have a good managing agent, our doors are always open. So, Alistair, let's move over to the CSOS topic. I'm going to get you to cover this. Karine, can you just move to the next slide, please?
Okay, thanks,
Okay,
so sorry.
Yeah, so as auditors, when you look at the definition as listed below regarding the admin fund, what is your understanding in regard to CSOS compliance when it comes to what should be included in the CSOS levy calculation?
Okay, Shahim, thanks. Very interesting question. And I think tying back to what Andrew mentioned just a little bit earlier on about what comprises the admin fund levy, it's very important to get this correct. We do see on the odd occasion, people sort of still not quite getting this calculation 100% correct, not necessarily in terms of physical calculation, but of what should or should not be included in the CSOS levy. So for clarity, because there was a lot of confusion, we actually did consult with CSOS, and I think that the definition here is vitally important. So if you look at that definition, it's any expenditure incurred in connection with a common property. So to possibly simplify that, what we'll be looking at is expenditure that is or can be reliably and accurately budgeted for. So I'll give you an example of what would be excluded from that would be recoveries which are billed in arrears. So items or usage, which does not necessarily form part of your admin budget. Also excluded from that is obviously your exclusive use levies and any special levies. But to give you a little bit of further context around that, we often see items such as security treated as a recovery. So for CSOS purposes, that is not, strictly speaking, correct. If your security is a fixed monthly charge and your rules have not been amended to allow for other forms of levy collection, such as a nominated value, and you are meant to collect your levy via a PQ schedule, security should be part of your admin fund levy. Should not be treated as a separate levy. You could call it a recovery if you wanted to, but when you're performing the CSOS calculation, you would have to take that into account. So I think that it's very important to distinguish between what is included and what is excluded. The calculation itself is pretty straightforward. Just need to backtrack there and say that there's also a little bit of confusion. People tend to want to read the sectional title schemes management act regulations, and they confuse utility sections, primary sections, etc. According to CSOS, according to what we've been explained, if your section forms part of your sectional title plan, it will attract the CSOS levy, irrespective of the usage of that section. So very simply put, our CSOS levy would be our monthly admin levy per your budget, less your 500 Rand exemption, 2% of that amount, and capped at 40 Rand a month per section. So pretty straightforward, just get the inclusions and exclusions.
So then just to confirm, the reserve levy is not part of the CSOS calculation?
No, no reserve fund levies, no special levies, no EUA levies.
Perfect, thank you. All right, so then we're moving on to the submission of the annual return. I think from a compliance perspective, we've got a workflow that actually is tailor-made to actually ensure that this is done. This is part of what we call an AGM workflow. What we do find is that, unfortunately, if this document is not signed, there is no relevance. So what we do recommend is that when we submit to CSOS, that this has to be a set of signed financial statements. As you can see, there's a snapshot of this actual CS2 form below. The submission requires you to log the actual CSOS levy for the annual, for the budgeted period, and also a copy of the annual audited financial statements. Thank you, Corinne. We will move on to the next slide.
Right, Shaq, if I may. Oh.
Corinne, can we move on to the next slide?
Sorry, that is the next slide.
No. Yeah, this one, yeah. Okay, over to you, Alistair.
I'm curious, Shaq, Shahim, you and I are both obviously involved in compliance, maybe different sides of the fence, but with the ultimate sort of same goal in mind. We tend to see things after the fact, whereas your team is very much responsible for monthly reporting. So, I've worn that hat, but I'm curious to know what today, specifically your team, or what goes into a good set of monthly management accounts, and what sort of preparation or what's involved in producing those accounts in today's complex environment.
Yeah, so just some history. I think, firstly, to achieve compliance, I think you need to obviously know with a reputable managing agent. What we've seen over the many years, unfortunately, is that there are still agents out there that actually, use Excel spreadsheets, and they don't even reconcile right up to balance sheets. So for us to actually ensure that the industry remains compliant, as a company, what we've enforced in our business is that, all our clients do receive a financial report back, and that is done religiously on a monthly basis by the 15th working day of the month. And obviously, this is also tracked again on our AGM workflow. And obviously, we really have a lot of, I think from our side, 80% of property management is really financial, and everything really is about our financial compliance. So what the packs normally entail is really a financial summary dashboard. There's obviously your trust account bank statement, there's an income statement, a balance sheet, a credit roll, and these reports are all available online as well, and also customizable to suit the needs of our clients. So I just want to take you just maybe through a couple of these like dashboard reports, so that we can just take a snapshot of what a potential client would be able to see on a monthly basis to be able to make good business decisions. So to the next slide, Corinne. So what you're looking at here is what we call the financial summary dashboard. This is really all our lay people who are not actually accountants. What the snapshot really shows is a view of your bank balances, your performance, your debtors, and also you can see it's got a view of the previous months. So in a nutshell, just looking at this example of this body corporate, you would see that they're quite compliant. A lot of money in the bank account. They've got a reserve bank account as well as an investment account and a trust account, etc. And I chose quite a good example because there's no arrear levies here. And obviously, it also highlights the outstanding creditors. We can just maybe move to another report. The next slide, please. So then it obviously breaks it down into the various funds. And here you can see this is the performance of our admin fund. Normally what we try and track, and this is also customizable, is really our top 20 variances. In this instance, for this body corporate, there's just really been one, and it had a material variance on garden. The other thing that it also looks at is, you can see on the reserve fund, there's a full balance sheet, a bank account, as well as the fund in itself, and these are actually matched with exactly what is in the fund. So here again, you can see you're quite compliant, and at the end of the day, nothing much to worry about. The performance to budget is marginally off, but again, when we do talk about the admin fund just now, you will literally see that it really is there just for a break even or a small surplus, because the majority of your funds are actually utilized for capital expenditure, as we would call it, the reserve fund. Okay, we can move to the next slide. Can we move to the next slide, please? Thank you. Okay, so a very important part of our business is actually levy arrears and collections. Now, a lot of the time, when we do forecasting, the assumption is that you're actually going to collect all the money for that financial year, but that's not only the case, because you do have what we call defaulting owners. So in most instances, it's important to have a look and see, okay, what are your levies in arrears? Who are actually your defaulting owners? So we have what we call a flagging system. And basically, you can actually flag whether someone is handed over and whatever status of legal they are in. But the graph below is quite an important one, because here you can actually see that we are collecting more than 90% of our levies on a monthly basis, which actually then does boost the cash flow. There with our actual buildings with huge significant arrears, you will notice that there are huge constraints when it comes to paying accounts, etc. So this is also one of the very important slides. We can move on to the next one, Karen. And then obviously, a very gray area in the industry currently is what we call the municipal recoveries. Obviously, on this particular example, there's no recoveries directly from the owners, but with all our challenges with all our municipalities in the country, with all the estimated readings, the under recoveries causes significant leakage across many of like the estates. And sometimes you don't get it resolved unless you appoint a consultant. So it's very important that we do track this, because some people can become some complexes can actually become insolvent by virtue of actually, if you budgeted 13,000 in a bill of 100,000 in a month comes through to you. So what we have on a monthly basis, also to our clients, we do a municipal recon. We actually highlight the recovery percentages so that if action needs to be taken, whether there be a leak on the common area, or there's a significant under recovery, or there's estimated billing, someone can eventually, immediately do action on that. And as you can see, we also log the outstanding creditors, and these are then also communicated on a monthly basis in these reports. Next slide, please. Thank you. And this is just typically what an income statement looks like. Once your budget is actually approved, we actually load it into our system, and on a monthly basis, we can actually track variances. This is what we call the multi-month detailed income statement. Obviously, it's customizable, but what's nice about it is you can actually see what is being raised, what expenditure is actually being paid, and you can look at history. And if there are, let's call it the material variances for you to actually take note of. And in this instance, this is quite a good report, and this is the administrative fund of this building, and they're actually still performing well according to their budget. Next slide. Thank you, Karim.
Can I just reassure everyone that they're not expected to read the small font. So don't be
Oh,
alarmed if you can't see the figures. It's very small, but the point is to show the format. So this just shows what a income statement looks like in a typical pack. It's one of our buildings where Trafalgar owns most of the units. But the point is that, all the months can be shown side by side. It helps with seeing trends. It helps to make sure that expenses are paid each and every month. It helps to see, overall what the year to date as well as the monthly costs are and a variance to budget. And, really what we're showing is all the key features to look for, to review, to check with monthly financial management reports. And the point is the pack gives all the right information in a convenient monthly pack to go through in a systematic way. It will become very familiar, very standard practice to a chairman, a finance trustee, all the trustees and directors ideally. Once they're in the habit of reviewing it, it shouldn't take more than 10 to 15 minutes to review once it's a repetitive cycle. If it's unfamiliar, I would recommend that an appointment is booked with the portfolio manager to go through collectively to get to grips with what information is presented and how to interpret the pack. But most certainly, all these features that Shaheem is touching on are very important. These are the financial indicators of monthly financial performance, of monthly financial health. And, as with any business, as with your personal finances, there should be a focus on what are your bank balances, what cash is available to pay creditors, what arrears are there and levy debtors, and are those being managed correctly? What is the status of those? Are creditors up to date and being paid, or is there backlog? Which are those creditors? As Shaheem said, the metering, do you have the effective metering in place to recover consumption-based services in your scheme? Are you recovering the right amount from owners so that the levies aren't subsidizing incorrectly municipal services being consumed, etc.? So I think that's the direction Shaheem's coming from, is just to showcase some of these key elements and don't focus on the figures, more just the concepts and the format, and really what 10 or 15 minutes per month needs to be assigned to in terms of reviewing this pack. And obviously, the first and most important thing is a pack should be provided each and every month consistently without exception, and it should most certainly be reviewed each and every month consistently without exception. And it's definitely best practice, for new trustees shortly after an AGM to decide who's accountable for doing that review, who is going to take responsibility for that, and then, what sort of feedback there would be to the other trustees if there are exceptions or deviations, etc. And remember, if there are variances to budget, your budget was agreed to cover, your levies were set to cover your agreed budget. If your expenses are now exceeding budget, it is going to put stress on the reserves, because by definition, then your levies are not covering expenses. And the only way the gap is going to be covered is to erode reserves. So those variances need to be a very specific focus. Why are there variances to budget? It needs to be investigated and understood. Those variances need to be managed to be reduced or eliminated, and then bringing expenses back into line with the levy budget that was agreed. And if that doesn't get managed closely, it can, accumulate, it can compound into a very serious cash flow problem, which could then stress service delivery at the complex. So, that is the approach which should be adopted. And if that is done consistently, it obviously keeps things in check. It obviously allows issues to be addressed quickly before they become big issues. And it obviously keeps the trustees well in tune with the financial performance and the financial well-being of the community scheme, with the benefits that I mentioned in the introduction. So apologies to interject there, Shaheem, but back to you.
not a problem. So Karim, just final slide on this sector. So the culmination of what we spoke about now is really to make sure that the body corporate or the homeowner association remains solvent. And that is really what investors look at. When you're selling your property, what new owners want to buy into. They want to buy into an estate that has got reserve funds, that is well managed, and that is actually compliant. So for me, in a nutshell, the comprehensive reporting can therefore assist with compliance as the information is readily available. What this also helps us with is that when you get to an audit, and Alistair will touch on this later, is that we're actually doing a mini audit on a monthly basis And after the 12 months, we really know where we are, what we're doing, and also with the budgeting, it will help when we do a new budget for the new financial year. Thanks, Corinne. We can move it over to the next slide. Alistair, is there any comments from your side?
Shame, it's interesting. You and Andrew have both mentioned that how the importance of a budget, because I mean the management pack is fantastic and it's a really useful tool. But if there's no budget that's been approved or loaded, it's really you don't have a base to compare it to. You can't really track your income or your expenditure. So it obviously drives a lot, and I'm sure it's quite a process to sort of arrive at that budget. Maybe you can share with us sort of the thinking or the thought process that goes into preparing a budget.
Yeah, so just as an introduction, I think the important part of budgeting is to have a budget framework. I think this entails firstly having a contracts register, reviewing the escalations, and then also the expiration dates of the contracts, and looking very carefully at your base costs. And importantly, what we also say is that a lot of people like doing a desktop budget where you sit it in the office and just assume, okay, everything's going to be 6%. But what we also offer is a visual inspection just before budgeting happens, just to ensure that we are aware of any other maintenance on the common area. This is over and above, obviously, the 10-year plan. And then also ensuring that the 10-year plan is reviewed and updated, because when you look at the two different funds that we will talk about, for the admin fund is really your day-to-day expenses. If we look at our own income and expenses, we have to have our own budget, and then we need savings to go on holiday, etc. And it's no different. And historically, how people used to treat the reserve fund is they had a gauge of about 3 months worth of levy. Now the regulations have given us guidelines as to how to do it. And unfortunately, we still have people that only want to deal with a minimum amount and not necessarily, like actually physically have a signed of 10-year plan. And I think for compliance purposes, it is important that you do have that plan. Okay. So we can move on to the next slide. So what we have is called a budget timeline, and I think there's various stakeholders involved in the process. It's not really only the trustees or the managing agent that has to do it. So what we do recommend, Alistair, is actually doing the budget in advance of the financial year end. And as I spoke about the contracts register, I think it's important that one reviews when does the actual security contract expire, the cleaning contract, or whichever service providers we are utilizing. So you can either go out for tender, actually make good decisions, because everybody these days has to try and save costs somewhere. And normally what people assume is that, they can compare their estate to another one. And just as an example, if you have 3 security guards, you can't have the same expense for security as one having 1 guard. And so it's not always the best practice to compare. And then also sometimes the yardstick is inflation. People assume that you can do increases based on inflation, but I always say that you have to look at the base costs. So when we do start the discussion with the budget, we recommend a 9-3. It's 9 months of actual, 3 months of forecast. And the trustees are then sent a draft by our team. Our process is quite automated. The template is quite easy to use. And obviously we then review, and sometimes we even have to do a line-by-line analysis of expenditure, obviously reviewing both the admin and reserve funds, and also making sure that the 10-year plan is updated. Once that is reviewed, as you all know, good decisions have to be made. Now, I always say that the yardstick is when you want to achieve the AGM, we have to make good decisions quite quickly. So a lot of complexes always either wait to the AGM to approve a levy, but as you know, the Act's quite clear. You can still approve levies up to 10%. So we would advise trustees, if they want to make the approval that is actually within the limits of 10, we could easily do that, so that when the first month of the new financial year starts, you actually can have a new budget with new increases, et cetera. And obviously, as you all know, once that budget is actually approved by the trustees, you can notify the owners within 14 days of the implementation. Obviously, if you don't have, if your increase is above 10%, you're probably going to have to do 2 budgets, one being the one that the trustees approve, and then at the AGM, just topping it up So to get to that 4-month window, there's a lot of analytics and work that has to be done behind the scenes to be able to have an effective budgeting process, Alistair. So just from my side, and obviously you're quite an expert in the industry, do you perhaps have any budget tips that you can recommend?
You touched on, yeah, certainly. I think you touched on a very important aspect. I think preparing the budget in advance of the financial year end is key. I don't think waiting till the AGM is great, because then you land up in a situation where you're behind. As you said, you have the ability to go up to a maximum of 10%. But if you have prepared in advance, the managing agents on top of things, trustees are on top of things, you're going to get close to a very accurate budget. I'd say as much as everyone focuses on the expenditure and on monitoring expenditure, the other thing we shouldn't lose sight of is keeping track of your income streams. Make sure that all your revenue streams are accounted for. Are you recovering an EUA contribution? If there are EUA contributions, when we audit, that's generally, we start with the plans and the rules, and we check for EUAs. We're not going to see rentals there, but we will make sure when we're doing the audit that we check for rental income, common property rental income. Are your additional insurance premium recoveries on particular sections, are those being recovered? So again, as much as your expenses are important, your income is equally important. The other thing I'm quite keen on is to, as far as possible, align your service contracts with your financial year. And I'll tell you why that is. Unless you're not, let me backtrack on that. I like to align it so that you don't have various increases happening through the year, if possible. If not, make sure that your budget has a detailed page so that whoever's reading that budget understands that 4 months into the year, that is when that particular service contract is due for an increase. I think by giving people detail, you're going to eliminate a lot of questions as to potential discrepancies on the expense figures 1 year to the next. I think also, in light of what you'd mentioned earlier on in terms of not recovering levies 100%, put in a small, if possible, a basic contingency so that there is a little bit to fall back on. I mean, at the end of the day, if it's not spent, it's going to be sitting in your bank account. I think something that today might be missed a little bit, and we are still seeing legal fees being fully debited to an owner's levy statement and not the taxed amount. So I would say practically you should be providing for legal fees on your budget if there is debt collection legals involved, because there will be a portion that's payable by the body corporate. So certainly make sure to include that in your budget. And then I think something for schemes which maybe are already in a little bit of trouble is if you try and pay or make a payment arrangement as far as possible, try and avoid incurring unnecessary interest charges. So if you can put a payment plan in place and save on the interest to the scheme, absolutely go that route. So those in a nutshell are my sort of top picks for, I mean, you have your obvious processes, but just little things to think outside of the box when preparing your budget. I'd look at those.
Thanks, Alistair. We can move to the next slide, Corinne. Okay, so this is obviously your area, Alistair, and I just want to introduce the discussion. So obviously the regulation on the slide requires the auditors to consider the accounting requirements, obviously as part of the audit procedures. Can you just elaborate on these for us, please?
Okay, Shahim, so those come from obviously the regulations, Sectional Title Scheme Management Act regulations, particularly Regulation 21, 24, 26. So 21 basically will speak to your loans, to your investments, your bank accounts, levies and interest. I think the ones that are more sort of pertinent maybe to the discussion, which we've had already, 24, your admin and reserve funds, and then 26 dealing specifically with budgets, financial statement disclosure, accounting, etc. I think it's important to highlight here that that is not the audit. There's a terrible misconception that the auditor looks only at 21, 24, 26. That is not correct. That is part of the audit those are accounting requirements. They're not auditing standard requirements. So we factor that into the audit, and we do check up on those things. So if we find discrepancies, or not discrepancies, if we find that the scheme is lacking and they haven't met those requirements, they would generally be listed on the audit report. There's a section for legal and other regulatory requirements. We would note it there. We would sometimes, I tend to, when it's, for example, insurance, which is not doesn't fall into regulation 21, 24, and 26, we put it as an emphasis of matter. So your scheme may have the necessary insurance, but they might not meet the minimum requirements. We would note it there. I think to touch on the reserve fund, which you did earlier on too, I think it's also important to note, you'll see on the financial statements, there's a note saying that the auditor can't vouch for the, not necessarily the accuracy, but the amount that's been provided for as a reserve. And the simple reason for that is, well, we're not engineers, we're not architects, we can check the calculations, we can tick the box to say, yes, you have the plan in place. We can go through sort of the mathematical or the accounting requirements of that thing, but we cannot say scheme A is sufficiently or has sufficient reserves to be able to meet their future expenditure. That's why we have that note, that particular note in there. So yeah, if you want to look for notes or things we've picked up, generally refer to your audit report. And of course, if it's dire, we would have a qualified audit opinion, but those are few and far between. It's certainly in our experience.
So in order to achieve compliance, and just considering the deadline to have your meeting, the AGM within that time frame, what would you deem a reasonable time frame to conclude an audit?
Shahim, that's a difficult, not a difficult question to answer. So we know that the Act allows us 4 months. So generally the way we like to approach it is, let's assume a February year end, we'll give the managing agent 1 month. We then like to allocate ourselves a month too, because things happen, life happens, there's always emergencies. And if you can have your part of the deal sort of done in the first month, and we can deliver what we need to deliver in the second month, that still leaves you with 2 months to hold your AGM. So that's generally what we work with. There are obviously delays, inevitable delays. When that happens, that note again on the AGM not being held in time will be included in the audit.
So can you just move on to a few slides? I just want to ask Alistair another question. Just the next one. The next one. Next one. Okay, the next one as well. I think it's going to be this one coming up. One more. Okay. So just from my perspective, and I just wanted your feedback, is that what are the most general audit findings that arise during the audit process? And also talk a little bit about disclosures, which will be on the next slide. Thank you.
Okay. So obviously we see quite a lot. I'd say there are the same general issues across most audits. So if we're looking specifically at income, you'd be surprised at the number of levies which are still incorrectly calculated. So we recalculate the levies to ensure that the PQ is correct. So I think that talks back to compliance on the managing agent side. You take on a building, I think it's one of the first things you should be doing is checking the levies. And similarly, when that comes to us, we will also check that PQ calculation. And again, if it's incorrect, we'll make the necessary disclosure in the AFS. Another, as I mentioned earlier on, EUAs, you're required to make a contribution. We check for that. That's very often missing too. And linked with that again, like I said, the additional premium payable. So we will scrutinize the body corporate's insurance policy. We will have a look to see whether the insurer has raised an additional premium, and obviously make the inquiry of the managing agent why that has not been billed. So that again, like I said, all ties into your budgeting. They all speak to each other. Make sure it's on your budget, make sure variance is noted in your management report, and we will be the final check on that. We do see still today reserve fund levies not being raised or being transferred into a separate bank account. As I mentioned earlier on too, we often see the insurance requirement is met, but not necessarily the correct value. Big one is still when we get off, we often, again, will be receive a set of financial statements, asked to quote, or the work comes to us and we look at the prior year financials, and disclosure is not as stipulated in Regulation 26. Levies are not broken down by unit. Creditors are not aged. There is no, I see you had it up on the screen, there is no reserve fund note clearly showing, what the reserve fund value is, what you have collected, and that is a percentage of the total and the shortfall, as well as the reconciliation for that year, your opening balance, what you've collected in levies and interest, what you've expensed, leaving you with a closing balance. That's very often missing, or we'll see a note saying refer to the managing agent. So that is not correct. That actually does need to be stipulated on your financial statements. Another big one we see on our levy rolls is units that have been sold and the balances just sit there and that nothing has been done to contact those owners or to pay back those owners who have long since moved on. Obviously, if it's in a trust account after 3 years, you need to pay it across.
So Corinne, just quickly move on to the disclosures. I think it's 2 more slides to go. Next one. Yeah. So just a couple of these, and just for people that don't understand financial statements, what is the auditor trying to tell you when they're emphasizing things?
Shahim, those are issues that we have found. Well, not necessarily issues. As I said, if you look at the reserve fund note or the emphasis of matter there, we are simply saying that we as auditors are not qualified to comment on whether your reserves are sufficient. We've checked it. We've checked that you've met the minimum requirement. Checked your disclosure, we've checked that you've got a separate bank account, but we can't tell you that it's enough. We don't live in the scheme and we're not qualified to tell you that. So that's the reason for that. As I mentioned, if you look there on this particular one, we've noted that there's insufficient fidelity insurance cover and we list the management rule. And that's just also, that should be, I think, this is something that is overlooked. I think your insurance policy gets renewed every year. You might tack on a little bit extra, but you need to do the calculation, which obviously we do, but it's post the fact. So I would say as soon as possible after your financial year end, let the portfolio manager, one of the trustees, anyone who's responsible for financial compliance, just let them do that calculation. Obviously very simple, your cash and cash equivalents at the end of that particular year, 25% of the next year's operational budget, and that will give you the amount of the minimum cover that you need to have. So quite a simple calculation.
Okay, and just to close off on disclosures, like at what point does an auditor then qualify a set of financial statements?
Shahim, we would qualify if we are unable to satisfy ourselves that the figures that have been presented to us are a fair reflection. There would have to be bank statements missing. There would have to be, we check for restrictions. Things would have to be really extreme, and the body corporate there would need to be virtually no control or no controls in place, no controls on the spend, no reporting, no documentation. It would have to be really serious for us to issue a qualified audit report.
Okay, thank you, Alistair. Okay, Corinne, we're just going to move over to our final topic, taxation. We all love SARS. So just to introduce this discussion, Alistair, so would you then just maybe give us some guidelines on why exempt entities are actually have to pay tax? And then also now with all the investment funds in the reserve fund, you will notice that this 50,000 maximum is probably not enough, and would SARS eventually maybe consider increasing it? So maybe you give us some words of wisdom. Thank you.
Okay. Look, as to whether they'll increase it or not, I'm not sure. It's been at that amount for many years. It's very difficult to deal with them on any tax issue at the moment. So just let's look at it in a nutshell. So first of all, there is a requirement to register. Share block companies, body corporates, automatic exemption. You do not need to do anything else. Homeowners associations, if there are any members on the call, take note. You are required to file an application with a tax exemption unit. Your exemption to be taxed under Section 10(1)(e) is not automatic. You do need to file a separate application for that. That is, the application is accompanied with your MOI. They'll check to see that you meet the requirements of a a community scheme. In other words, so they will exempt your levy income, and you're obviously only taxed on any other income in excess of your 50,000 Rand allowance. So just to clarify that too, if there is other income and there are directly attributable expenditure. So this is not expenditure generally in connection with common property. You'd be looking at rental income, any other form of revenue that your scheme can generate. If they are, and you have to be able to prove it, directly attributable cost, you can deduct that from the other income and then deduct your 50,000 Rand exemption.
What are those examples, like bank charges, audit fee? What are
No,
those?
so that's a general allowance that you're allowed after that. That is generally restricted to, again, expenditure that is not tied to the common property, and they generally limit that to bank charges, audit fees, and accounting fees. That then is calculated on what they do is they take then your taxable income, which you have calculated, they divide it by your total income, and they multiply that by this expenditure which you can claim, and that gives you a percentage. So once you've calculated your taxable income, you've deducted your 50,000 Rand, you then get another small deduction, and your final tax liability is calculated at the prevailing tax rate on that figure. It's really straightforward. There's a great interpretation note which sets it out very clearly. Yeah, not overly complicated, just to keep in mind any other income earned not in connection with normal community scheme activities is going to attract tax.
Thank you so very much, Alistair. Andrew, we've concluded all our slides for this evening. I don't know if you want to have any commentary. Thank you.
Thank you. So we'll keep any questions sort of responded to. Alistair, we find, more and more trustees and directors are concerned to sign financial statements if it applies to historical periods where they were not trustees or directors. And this then becomes a sticking point for the AGM because, as I said earlier, the AGM requires signed audited financials to present and review. What is your sort of advice to new trustees and directors that are then asked to sign historical statements? How can they set their minds at ease that it's appropriate to do so, that they can have confidence in what they're signing, and that they can facilitate the AGM to continue, and obviously the financial governance cycle, to continue as well?
So Andrew, how we've dealt with this historically, look, fortunately, it doesn't happen too often, but it can happen. So I'm a big believer in trustees engaging directly with the auditor. I think it's important. Our whole industry is built on relationships. I feel if there are questions to be asked and trustees and directors' minds need to be put at ease, arrange a meeting with the auditor, have the discussion. I would further go on to say the financial statements will need to be signed, but take it to the AGM and have it resolved by the members, possibly after, if there is a circumstance or there's something questionable that needs to be explained, take the members through that and obtain a resolution at the AGM saying that they have been approved. And, at that point, possibly the trustees or the directors will feel more comfortable signing those financial statements. But I think the thing is, satisfy yourself, speak to the auditor, obtain the knowledge that you need to give you the comfort to sign the statements.
There was a question, we've talked a lot about sectional title and bodies corporate, which obviously applies to sectional schemes governed by the Sectional Title Act. But would you agree, Alistair, a lot of the principles of sound financial management and governance are equivalent for sectional title schemes and homeowners associations?
Absolutely, Andrew. I think, the sad to me, and again, I'll be I believe that my personal opinion is that the Companies Act is not particularly fit for purpose in dealing with a NPC homeowners association. But you're absolutely right, no difference. In fact, probably, taking into account that your larger homeowners associations, I'm talking your lifestyle estates, you are talking millions of rands. I think there's even a greater need for stricter financial controls.
Alistair, one of the sort of challenges is that, in most cases, budgets are set with the levies to cover expenses. And it doesn't necessarily make provision for levy debtors and, potentially a quantum of known levy debtors. So at any one time, one can look at the levy roll and there may be certain debtors that are unlegal. And we all know that legal process is long, it's arduous, it's expensive. It takes many months, 6 months, 12 months, 18 months. Certain parts of the country are much longer because of defunct sheriffs and other issues. But, should there be provision in a budget to allow for levy debtors? And how would that look in terms of the budget setup and approval at an AGM?
Andrew, I think probably Shaheem is better placed to answer this. But as I said earlier on, I do think make provision for certainly a contingency. That's going to assist. Make provision for legal fees because they will come and should cover your portion. We don't see it often in sectional title, but we do see with the homeowners associations, and obviously it's only a budgeting item. It's not going to reflect on your financials because levies are not permissible. You're not allowed to write them off, but they will make a line item or they will make a provision for doubtful debts. And I think that's how they generally factor in not receiving 100% of the billed levies every month. I think, again, Shaheem would probably be better placed to answer, but if you're going to take it to an AGM and you have the approval of the members, then purely from a budgeting and a cash flow point of view, obviously with the full knowledge that it's not going to be written off, we would be fine with that from an auditing point of view.
Alistair, there was a question on emphasis of matter, in the financials. Often the draft financials would be provided first for checking for the trustees to review and agree. The emphasis of matter would first be sort of visible there, but because it's draft, there would be an opportunity to potentially address that particular, emphasis of matter or qualification, etc., and to resolve it before the financials are finalized and signed off. Can you just maybe comment on the opportunity to resolve some of those between the drafts and the finalization and sign off of the audit?
Andrew, 100% correct. We're going to obviously note what we find. That is why it goes out in draft format, as you say, and we do. There are trustees who are very engaged, others not so much, but the ones who are will often come back and say, why have you said X, Y, and Z? There will be a discussion. And obviously, if proof or evidence countering what our finding is presented, absolutely that emphasis of matter will be removed. That's exactly what that, and again, why I say I encourage communication directly between the trustees and the auditor, because I feel like when often there is a breakdown in communication or what you're trying to say because we're working through a third party, which is not wrong. I just think it would cut out and ease, quite frankly, make the managing agent's life a little bit easier. Let people talk directly, let them solve the issues and get the financials sorted and signed.
Yeah, and I think that's a very good suggestion that, the auditors are available, they're accessible to answer questions, to, understand better the financial statements and any, notes or qualifications there, and to learn from it and to then apply that knowledge to the next financial year. So I think that's very important. There was a question about sort of an unexpected expense or project, etc. Theoretically, the trustees or directors are bound by the approved budget, also by directions and restrictions on the trustees on what they are authorized to spend and approved to be paid on behalf of the community scheme. And just an important note to say, if something changes, if there's an unforeseen circumstance, which arises, fairly often, in fact, the advice would be to convene a special general meeting, present a revised budget, and have a revised budget approved so that that unforeseen expense can then be addressed in an agreed way and in an authorized way as well. So, it's not the end of the world to call an SGM. It's standard practice to deal with a variance in that way, do it proactively in advance, and do it in a sort of, controlled way so that the trustees aren't exposed or the directors aren't exposed in terms of authorizing expense which wasn't correctly approved. Right, we are coming into our last minute, so maybe just sort of some key takeaways from my side is, as I said earlier, agree roles and responsibilities shortly after the AGM, as you've got your new board of directors or trustees elected. Make sure it's clear who's going to do what in terms of financial management, and make sure that all the trustees or directors know who has taken responsibility to review the monthly management reports, what information they can expect. Do not allow gaps in terms of monthly financial reporting, and do make sure that the key elements of those reports, some of which we touched on tonight, are reviewed, are interpreted, and that you know who to raise queries with. Typically, it would be the managing agent, whether it's the portfolio manager, but certainly we recommend the accountant is directly contactable as well. So, governance can be achieved. Good governance can be achieved. It might seem daunting at first, but certainly, the managing agent, the portfolio team, their accountant are available to assist, to help navigate the key elements of it. And with repetition, because it is a monthly cycle, it then becomes, repetitive and fairly straightforward. And it's key to making sure that your scheme remains on track, that your services can be maintained because your levy income is being collected, is covering your costs, and that you are compliant with all the key regulatory bodies. So it's 6 o'clock. I'd like to thank you all for attending. Many thanks to the panelists. Thank you for your time. We will circulate the recording to those that have asked for it, together with the slides. Please do answer the survey if you're comfortable, and we look forward to convening next month with our next monthly webinar. Have a good evening, and thanks once again from Trafalgar.
Thanks, everyone. Bye.